Good morning, everyone. We are back live with the Prospero.Ai stock market live streams. We were going to do one stream possibly last week, but I was on vacation and couldn't make it happen. So glad to be back. Happy to see everybody rolling into the stream. Give us a like if you're happy that we are back because we have a lot to update everyone on what's going on in the market. We're going to start off with a longer than usual George market update to catch up everyone on what's been happening in the market while we were gone, how we're feeling about it now. The market is crushing it so far this year, but we are now in the second half. So can it remain? All the indexes are at or near all-time highs. But without further ado, let me take you through some of the topics that we're going to be getting into today after the market update. Which will cover chips, specifically SMCI and the QQQ during that market update. Also, if you get our newsletters, you probably read that George is talking to a lot of people that have high up positions on Wall Street from past connections that he's made, and a lot of them are at the highest cash positions they've been. So we have to discuss that and talk about what that means for investing. And then we'll get into Chewy stock, which, a story broke while we were gone about how Roaring Kitty took a 6.6% stake in the company. And there's a ton of connections between GameStop and Chewy. We'll get into all of those and why Roaring Kitty was interested in Chewy. Next, we'll take a look at Disney stock, which just had a massive hit in their standards. A movie, comment in the chat if you know the one I'm referring to, just crossed the $1 billion mark worldwide. And I think I heard this morning it's actually up to $1.2 billion, which is the first movie to do that since last summer. A little movie called Barbie, which took over the world by storm, did that. So we'll talk about what that means for Disney stock and outlook for rest of the year. And then we'll get into two powerhouse brand names that just haven't been able to catch the positive breath of the market. And those two stocks are Nike and Starbucks, both, I believe, if not at 52-week lows, pretty darn close. And it's kind of funny because they're trading at around the same price of around $75, which doesn't really mean much other than it's just funny to connect that. But we're going to kind of do would you rather. So Nike stock or Starbucks stock, they're such powerful brand names. Almost every American household knows about them. Which would you rather buy at this point for the future? And then Tesla stock has been ripping while we were gone. Let's see where it went from and to. I believe it crossed over 250 today, which is, it's at 254. It's about to hit 255. And just a month ago, it was at 167. So pretty incredible move in the stock. I think we're going to talk about whether it's a short squeeze, whether this rally has legs. I know they have a big announcement coming up in early August about the progress they've made on self-driving. So is this rally kind of pricing that in, and it'll be a sell the news when that event comes? We'll get into all those details surrounding Tesla. And then we have two Apple stories that we're going to finish off today's stream with. One will be Apple versus Epic Games. So there was a major update that happened in Europe where Apple is now going to allow Epic Games to have a marketplace for gaming on the iOS App Store, only in Europe at this point. But Apple has tried to hold the stronghold they have over the App Store so strong. So this is a crack in the armor. Hello, George. Welcome to the stream. Good to be back.
Yeah, back in it. I'll be right back. I hear you doing the update.
Yeah, no worries. And then we're going to talk about how Microsoft sneakily announced to all their employees located in China that they want them to switch from Androids to iPhones. And I find it funny that this news comes out after the whole ChatGPT and Apple iPhone integration that was talked about just about a month ago now, probably. There has to be a connection there. And it's funny that to see all of the details that aren't on the headline when stories are published come out as time goes on, and all the backdoor stuff that happens in business. And that will do it. Like always, we love getting your questions, comments, concerns. So comment away in the chat. We'll address all of the topics that you want to talk about and that you're curious about. We love when we get some comments from our viewers. Let's take a look at the SPY and the QQQ net option sentiment for today. The QQQ is at 57, so holding strong. In the beginning of July, July 1st, July 2nd, it bottomed out about 51 over the trend, and it's regained steadily back to 57. So that's still looking pretty bullish. And the SPY is at 48. And the SPY actually got way lower in early July, down to 38, and it's come back even stronger than the QQQ. So SPY is in a clear uptrend the past week, and the markets have moved higher along with it. So George,
All right, we're ready to go, right?
Yeah, I think since we were gone last week, we need a major market update from you, and what you're seeing in the markets, how you're feeling about it currently, kind of just a big catch up, and how you're viewing everything that's happening in the stock market currently.
Yeah, so obviously the tone of the last few letters has been very different, especially with QQQ net option sentiment like maintaining kind of this like consistent high levels. We've seen that, and obviously our tech portfolio has been doing very well as a result. There are a few things to note there. Not only have we kind of seen SPY net option sentiment not stay, as you alluded to, not stay in as bullish levels. So that has us being a little more cautious, being opportunistic with shorts on that side. But we've definitely seen less consistency in the chip makers. So we've been kind of avoiding NVIDIA because it's been so volatile. SMCI, which has been a great stock for us, has been something we've been in and out of just because of the volatility. Like, again, it's up big today. We're glad we held, but we've seen it be kind of like up big, down big. And we do often see it be kind of the most volatile chip stock, but there just seems to be too much inconsistency in kind of this theme that we've been talking about, or whether I think especially chip stocks have become overvalued. That's why we've been leaning to, in this kind of like tech strength time, we've been seeing Broadcom be a lot more consistent. That's why we're leaning on it. We've seen Microsoft, a stock we're leaning on a lot more because that's tech AI, but doesn't have the same kind of like chip exposure and kind of the uncertainty around the valuations there. So that's definitely what we're looking at. I think there could be a time, especially after another set of earnings, if these chip stocks continue to show growth and consistency. And I think one of the reasons SMCI is up today is I just saw some big investors, billionaires getting out of NVIDIA and into SMCI. We actually saw Pelosi get into NVIDIA and Broadcom as well. So that's why we've really been recommending Broadcom. And indeed, Broadcom has overtaken NVIDIA as like the top net option sentiment stock for a while now. It's been very high in net social sentiment, very high in net option sentiment. So we think that's a good way to get tech chips exposure right now, Broadcom especially. But we're definitely seeing softening in chips on the whole. So you might want to lean into tech stocks away from chips and then be opportunistic besides that. Obviously we've had stocks like Eli Lilly that have done well for us all year that we continue to be in. That's kind of like tech adjacent. But I do think, we put it in our newsletter. It is definitely a stock picker's market. So I think you definitely have to be opportunistic and quick with your trigger fingers to get out, quick with your stops to get out. If that's something that you do, to make sure you're not missing kind of these small corrections that we're seeing, and then kind of lean into your winners. That's what we've been seeing the best of. And an interesting lesson I just kind of want to cap off with is we did go into Celsius because we saw it going high in net social sentiment, and we thought maybe it's a time where social sentiment is going to do well because it's a very active market right now. A lot of interested retail money getting into this kind of what looks to be kind of a surprise bull market. And even that didn't work out for us very well. So we got into Celsius at 100 net social. We've seen it kind of fluctuate there. But I would say even in this market that's, I would say very, frothy for social sentiment stocks, we still aren't seeing that consistency from social driven stocks. So that kind of is a lesson that we have to learn over and over again to not orient a thesis around that. All right, I threw a lot at you, Stephen. Any questions?
Yeah, definitely. So I think you would categorize yourself as a defensive investor, kind of like for a majority of the time. But it would seem like now you might even be uh, heightening those senses and becoming even more of a defensive investor, especially in the area that has carried the market in the first half, which is within the AI chips. Like you were saying, kind of look for places outside of that. So that seems like a major switch up to me, just in terms of first half versus second half kind of stock market outlook. But then also, I wanted to definitely cover in the newsletter, you mentioned how you were reaching out to some of your connections and they were mentioning how they're in very high cash positions. Can you talk a little bit about that? Why they're doing that and what that should mean for a retail investor when the smartest
That
people
was
on Wall
actually
Street are doing it?
Matt. That was actually
Uh,
Matt, the other writer. But yes, I mean, I think we're both hearing, I would say, nervous institutional, things in terms of just like, I was actually interviewed by a major publication because people said the Mag 7 is overvalued. And actually, since I've had that conversation, I probably look pretty smart because I've been arguing the other side. Um, but yeah, I think that like a lot of institutions are nervous about this because, I think it kind of goes back to a story and something that I always think about that we talk about with Buffett, where, Buffett turned down Amazon and he says that was one of his biggest mistakes just because he thought they couldn't match the growth that Bezos was projecting. And at that time, indeed, value investors did not invest in tech stocks at all. So I think value investors drive the market. They can be slow to adapt to changes. And I think they're just looking at this new kind of insane pace of like, let's just call it Nvidia growth. There's, anything around, but like Nvidia is the only thing that's growing at a company of its size at unprecedented levels, right? So they look at that and their models, their mental models tell them insane growth like that can't continue, right? But I'm of the belief that new equations form in the market all the time. And this new equation that we're seeing or new equations, I would say, is AI driving the market without breadth. That's something that we talked about specifically that we're kind of seeing this year is, not the case. And the one thing that I always like to look at what people say and what happens in order to understand if there might be new frameworks in the market. And I remember saying here, because this is what I was hearing, everybody said, unless rate cuts happened at the beginning of this year, it was going to be a bad year, right? What's busting up that model? AI just growing at this torrid pace. We're not having breadth. We're not having rate cuts, yet we're having a very stable bull market. So that's telling me that there's new equations in the market, right? And new equations in the market doesn't mean it's just going to charge off and continue to hit all-time highs, right? We might see a correction, but the new equation I'm seeing is AI carrying a bull market. Like we're seeing that, we have data on that, and I think it's silly, like we're talking about with, Buffett basically denying that Amazon could keep growing at those rates or faster. He didn't see new equations there. And I think value investing is slow to see new equations, new patterns in the market. So the way I look at this is I see a new pattern. I see a new pattern of AI being able to carry the market, and how far that pattern can go, who knows? But I do think that until otherwise seen, this is a market capable of being carried by AI. And that's why I mentioned kind of at the beginning, we are going to have to continue to see earnings, because if the torrid pace of earnings growth, revenue growth don't continue for like key chips manufacturers, places like Microsoft, Meta, Google, we're going to have to continue to see growth and continue to see, good economics from them. And then, we will see it continue to grow. But I think on the other side, we will see a sensitive market that could see a strong correction if we don't see that growth continue. So that's why we kind of are staying like increasingly long versus short, but not assuming that these new equations will reverse when we see no evidence that they have yet. We can't bet against equations just reversing just because that's our comfort level and that's what we've seen in the past. And I think that's what we see the way some kind of entrenched people are talking about the market. And one other thing I will say is like Prospero teaches a certain process of looking at net option sentiment, QQQ, SPY, the numbers. And I think a lot of the way people advise retail investors are assuming that they won't be fast to act. So I think bringing people into cash that won't be relatively fast to act is not a bad strategy. We just preach a faster to act strategy than that, where we assume if we see these numbers going down like QQQ net option sentiment, that you'll be fast to act defensively. And that's the process that we teach. And we think that's a better process.
So I wonder if the following situation is one of the new algorithms in the market, the meme stocks. We had an update while we were gone about Roaring Kitty getting involved with Chewy stock, and that stock was going crazy. I think it was all the way up to $35, and then it was back down to 25. It was trading like a meme stock after that. But he has a 6.6% stake. And I think it's interesting how Chewy and GameStop are now connected with Ryan Cohen. Maybe if people don't know how, we could explain that for them and just talk about maybe if the Chewy trade has any potential or what's going on there.
Yeah, is he the CEO of Chewy now? I don't know. I mean, Cohen is obviously the ex-CEO, or is he still the CEO of GameStop? I don't know if he stepped aside.
I think he was the founder of Chewy, and I don't think he's connected besides being a shareholder now. And then he's the CEO of GameStop, I believe.
Okay, got it. So yeah, we're gonna do a whole meme stock education piece on this because one of the things that have people connect these events and talk about like short squeezes and the like is this event called MOAS, which is the mother of all short squeezes. And I've been hearing about this since I was an AMC investor that basically says, hey, the market is unstable. We're going to get these short squeezers. They're over leveraged, blah, blah, blah. And it's all going to blow up. And these names like, people like Ryan Cohen are on the inside, or Adam Aaron at the time. That thesis has definitely lost steam as he dilutes more and more. But the thing that kind of blows up this theory is that people talk about margin all the time and leverage. And margin is just a marker of profit. We're going to get to that in a second, Victor. Margin is just a marker of like profit and your cash position, right? So if you enter $100 million short position on 20% market margin, you've put up 20% of the value of the position, right? Let's say that position, it doubles in price. You put that in when the stock was $10 and it's gone up to 20, right? Your new margin will be an additional 20% or 40 million because that position, the market value of it is 200 million, right? And a short is a loan. So in order to honor that short, you have to put in more cash, right? But however, a lot of these short positions, and if you can look at like AMC, GME to a lesser extent, but AMC will use it because that's the easier example of like shorts being in trouble, right? AMC has been down like close to 100% since a lot of these shorts have stopped. So what does that do? That decreases your margin requirements the more that short is in profit, right? It decreases your margin requirements. That actually gives you cash. You take cash out of that trade. Even if you haven't closed, you get less margin pressure and can pull that out. So the idea that a market that has been so good for shorting these stocks and so good for stocks overall, where like lots of positions are in profit, right? Longs that have done very well, that decreases margin pressure. So the idea that we're closer to a short squeeze in this very profitable market for people that short stocks, in this very profitable market for institutions on a whole, because it's been a bull market and a lot of them are long, that doesn't mean that some stocks that have been like shorting a lot in a bull market are in trouble, right? But the market at a whole has been very profitable. So that doesn't put pressure on it to blow up. You kind of need the market going in a direction that people haven't expected for the market to blow up. And people being in large cash positions is an example of lack of margin pressure. So people are operating under the assumption that, when they follow Roaring Kitty or, anyone into these trades, that it means that institutions are in trouble when there's just no evidence of that. That doesn't mean some aren't in trouble. There could be some that get hurt by these positions, but we haven't seen a lot of blowups. And the fact remains that funds blow up every year. I remember when we saw Evergrande blow up, people were just like, oh, it means MOAS is coming soon. The dominoes will fall. But we didn't see that. Why? Because institutions blow up every year. And it doesn't mean they're in trouble. It just means institutions on the whole are in trouble. It just means that sometimes every year people make bad bets. There's winners and losers on every side of an institutional trade. And we talk that all the time. And some end up being losers and blowing up. It doesn't mean the whole system is under pressure. So when you see these short squeezes, you have to remember that a lot of the time there's institutions, especially now, that are profiting that much more than the ones that are losing. There's tons that short stocks, that push narratives around them, that they're being shorted, and then they make money as they're shorting them. They buy call options as they're shorting them, so they make money as they're going up. And then they decide when the game, as we call it, of musical chairs is over, and then they pull the rug, they buy put options, and they make money on the way down. Institutions make money on any trade that is expected. And right now, retail has become very predictable in terms of how they chase their stocks. I think there's very well a chance that Roaring Kitty could be in on this with some institutions, or at the very least, they are aware of what he's doing, whether or not he's kind of complicit in alerting them. It's very easy for them to find out what they're doing, track his trades, as we saw Unusual Whales track his trades. If Unusual Whales can do that, it's very easy for institutions to do that. And, you might make money. It's hard to make money on these, quick momentum plays, but you have to accept at this point that institutions are expecting them and you're not getting the better of them. I'm sorry. That's just not what we're seeing. Even if it's a select few that you're getting the better of, it doesn't mean you're getting the better of on the whole. Pick a new trade if you want to and a new strategy if you want to sneak up on institutions again. You're not sneaking up again on them now. I'm just sorry.
And I think that, the hard truth that you just delivered, I think that's kind of actually a great pitch for the net option sentiment signal. So you could see what institutions are actually doing with their money instead of trying to guess or trying to have these like conspiracy theories, about what they're doing or what levers they're pulling. You can actually see where they're putting their money with the net option sentiment. So I think that is kind of a great pitch for that signal that we deliver.
Yeah, I mean, you could maybe share it if you have time, but one of the things, we were out in front on both upside breakout and net option sentiment of this latest run up for GameStop. We actually saw it, for people that were like, oh, it's retail. Like, no, we saw institutional bets coming in very strongly, before that occurred. So we were seeing signs of it. That means institutions were really making big bets before Roaring Kitty even said anything. And that kind of blows up the idea that it's a secret retail trade led by retail. It was at one point, but it's not
now. So I think we can get right to Victor's question about Tesla. It was one of the stories we were going to cover today anyway. The stock has been rallying hard. I mentioned at the beginning of our stream before you were on, it was like 161 about a month ago, and today it's over 250. So pretty crazy rise we've seen. Not an insane amount of news that has come out. I know they beat on delivery numbers, which was released last week. There is a big day, I believe it's August 8th, where they're going to cover all of the tech innovations and advancements that they've made in self-driving. So maybe the market is pricing in a bit of that in advance. Maybe we could see a buy the rumor, sell the news. We'll see what you think about that. And also, could this be a bit of a short squeeze, or is this all fundamental buying, or just Tesla breakdown?
Well, let's see. Yeah, I mean, there's heavy short pressure on Tesla. I think we're seeing three things. I think we're seeing, a bit of a short squeeze. I think we're seeing it more and more likely that Trump is going to win. And I think Elon Musk has aligned himself strongly with, conservative, I'd say, talking points, among other things. And it's been very polarized, I think, where, there's talk of people that are liberal leaning buying less Teslas. And I think that's kind of sent conservative people to, buy more Teslas. It's become a real, a real hot button issue. And we talk about it all the time. We've rarely seen, any public company CEO align themselves so much, I would say, with one political party or the other. I mean, you certainly see some things, and obviously a place like Meta, got kind of, a lot of people talking against it because there was perception that they were, kind of filtering more comments. And, there definitely seemed to be some smoke to that fire. I don't really want to comment on it beyond that. But I will say there are people that are more associated with it, but you didn't necessarily see, Mark Zuckerberg come out like kind of parroting talking points for liberal talking points. It was more just like kind of talking about kind of some things that were more leaning away from some things that I'd say some liberal people find to be scary on the conservative end. That being said, I think there is a much stronger association with Elon Musk and kind of conservative values than we've ever seen for a public company CEO. So I think the likelihood of Trump winning, I mean, we've seen in this polarized environment, political, parties definitely leaning on corporations in ways that they view are, more friendly towards them. So could I see, with this alignment, Trump and Elon Musk working kind of closely together on things that would help Tesla? Absolutely. And I think we're seeing some of that obviously in DJT stock as well. I think we're seeing like more and more of that maybe alignment of the polarization that we haven't seen as much historically. So I think we're seeing that. And then I think we're seeing Tesla become much more of an AI company, and AI and them, leaning into that, them becoming, a lot more, they got rid of their superchargers. They're really focusing more and more stories about them pushing self-driving because that could be, a big product for them. They're pushing it in China. So I think we're seeing like a reaction to that. And when you look at stock value, you might say, hey, like their sales are down, they see some numbers, but, stocks are priced on potential. And right now, there would be huge potential if full self-driving did well, if, the Trump administration helped it roll out a lot more. Obviously a friendly president to that could really, really help the situation. So I think people are starting to bet on that and full self-driving and Tesla kind of being a leader in that. And so that kind of says the sky's the limit on the values there. Now, obviously there's risk factors, like it's got to work, there's problems if, they have accidents. There's a lot of unsolved problems in terms of what happens if there's accidents and who's responsible. If it's like the company, if it's municipalities that allow them to, pass these laws and go out on the streets. It's a lot of uncharted territory and a lot of risk and a lot of reward there. So I think that's basically what's being priced in. But there's a lot of upside that I think is going to be priced in. And stocks are about belief as much as they are about valuations. And if people believe this full self-driving is going to work, it's going to be the next big thing. Tesla is going to be a leader in terms of their allowances to be out on the road and can have some exclusivity, maybe, taxi contracts. A lot of that could become a reality if it has a friendly administration, which it looks more and more like it will. So I think that is a very, very interesting upside there. Obviously, it's a big divergence because with sales kind of going down, they're really dependent on that. So if it doesn't work out, that could really send the stock going the other way. But I think, it is a potentially huge thing that we might see more and more people betting on. And to us, it's too much volatility, too much upside, too much downside. We've been putting it in our trading portfolio. So that's a comfortable amount of volatility for our trading portfolio, but kind of for our higher conviction, investing portfolio, it's been too much risk for us. But we could be convinced otherwise if we see stronger upside breakout numbers, stronger net option sentiment numbers, and kind of some of the shorts leaving the trade. It's at 90 short pressure right now, which is a little high for us, but that's what we'll be looking out for.
So I was thinking about while you were speaking, if you would suggest someone to, maybe sell a little bit, take some profits from this rally and whatnot. But it actually led me to another thought. So say you're someone who bought Tesla and it was like 5% of your portfolio and you're just a long-term investor, buy and hold, you're in it for the long term. And Tesla stock, this is just random scenario, 10x's and it's now 50% of your portfolio. What is your philosophy behind that? Do you sell stocks to keep them like allocated correctly? Do you ride your winners? How do you think about that if you're like a buy and hold long-term type of investor?
I never tell people how to allocate their portfolios, but I don't think you ever want 50% of your portfolio in any stock, um, especially one with the high risks, like binary risks of this AI thing working out well for Elon Musk. Because you also have to remember the other part that we didn't mention, um, is that his compensation package passed, but last time it was challenged in court. And, that might happen again. And that might cause a huge risk, even if just getting challenged in court. If that happens again, then he might do what he did again and say, oh, maybe I'll build this AI in another company. That's like another risk that we haven't really named. There's so many risks involved. Like I would say there's such high rewards and so many risks that, I wouldn't recommend any more than 10% of your portfolio in Tesla. And that's based on like what I would do. I wouldn't put any more of 10% of my portfolio in a company like Tesla with all that risk. Or really, I rarely put anything like that unless I feel that there's a good degree of safety in it. But I'm even just like thinking back again of my investing portfolio, and I don't think I've ever had, that kind of concentration. Looking back on it, maybe earlier on when I just had less stocks, as I've expanded it, I don't think I've seen anything like that. So yeah, I just think that's too high of a concentration risk. But I also think you always should put your money in what you believe in. And if you have that high degree of belief in Tesla, any stock, like I'm not going to tell you that you shouldn't put your money in something that you have high conviction in. Just for me, my risk profile, that's too much concentration risk for me. And like Tesla, as I said, as a company, is just too much like news event risk, for things like, something Elon Musk might say that could scare investors, or something that could happen with the election that might look like things are going the other way, or his pay package getting challenged in court. There's just too many things, too many risks, even outside of the company, and kind of what we've seen, like falling sales for their cars, that, that make me say, I just don't think that's an appropriate amount of risk for me right now.
So don't put all your eggs in one basket, folks. That's a takeaway there. We had a story from Disney. I wonder if you saw this movie, George, Inside Out 2. Did you see it in theaters?
No, I didn't, but I did like the
Oh,
first one.
I did also. I didn't see the second one yet. Maybe I will after the great response it's gotten. It's crossed the $1 billion mark worldwide, which was the first movie to do that since Barbie last summer. They actually updated it today. It crossed $1.2 billion, so it's still rising. Good for Disney stock, which had some concerns about the content that they're putting out. I feel like recently there's been a lot of swing and misses. Um, Disney stock is kind of pulled back. They had a good last earnings, but now they're back under $100. I thought we'd just use this, you know, successful movie of Inside Out 2 to kind of talk about Disney stock and maybe if they're looking well positioned as an investment right now.
I mean, net option sentiment has been going pretty higher, like pretty good. I mean, I think probably around this. Um, but no, I don't really love them as an investment right now. I just think that like downside is higher than upside, which we always say is like a dangerous thing. And I just think like, streaming was, I think, and the way they approached it was a pretty big mistake. And they kind of like leaned away from their core businesses. Um, so yeah, I think that we're definitely just not in a good profile for them. I think we're going to have to see institutions have more faith in them long term before I think it's kind of an investable company at all. Like, and I think that's the problem when you see like even their core businesses like doing well, like their movies or their parks or anything like that. Like, I think they've done too much to get away from their core businesses that they've become kind of a scary investment for people.
So, do you think the AI tech and tools that are going to come out in the coming years will help entertainment companies, Disney and others, or hurt them?
I mean, I think there's still a lot to be seen um in terms of like how good those tools are. Like, and the laws around them. I think we're still figuring that out. And obviously, um a lot of people are fighting some of this copyright stuff. I don't think the economics are quite figured out. I do think on animated movies, it's going to make them way cheaper to make. But animated movies are not really the most expensive to make anyway. Those are pretty high profit margin movies. But I just think it's too hard to understand the landscape. And I think obviously like the artists in these movies are really fighting it. And I think what we could see is movies going away from big studios. Like, I think we could see, artists, and I've even talked to some people in these fields that have talked about moving more away from the major studios, and maybe forming their own, these powerful like content producers. And like, that's the thing. I think if actors get their act together and, whether it be like, forming their own studios or things like that, I think the actors for now are the big draws. And they might say like, hey, if we're gonna have basically like our union kind of cut out of this, if there's going to be less and less parts for like people that like we care about in our broader union, whether that be like people like editors or sound people or like smaller parts, I still think the big actors are going to be driven. It's we live in a star driven world. But yeah, I think it kind of has to shake out if we see kind of the bigger actors siding with people, siding with other people in their unions, and people like writers that who might be threatened by like AI writing, like, or they're just like, well, I'm gonna, like, as long as I'm getting paid, like maybe these jobs are gonna die and there's nothing I can do about them. We have to see that. But if it goes more of the latter, where I think the stars just kind of accept that they're there for good, but maybe other people in that field are not going to be around, then I think we're not going to necessarily see, then we will see, these places become a lot more profitable again, and Disney being a good business to own. But like, we really have to see how that's going to shake out. Like, but I will say like there's two new like Prospero engineering interns. Both of them work in the entertainment field and, kind of in like, more in the background. And they're both kind of worried about their jobs and they're getting into a new industry. And that's the kind of like smart switch that you might see more and more people see. Like, hey, I'm going to become an engineer outside of, the business or the industry, as they call it out there. So yeah, I think a lot still needs to shake out. But overall, I think it's going to be hard to stop kind of the path of AI coming in. I think it's going to be very hard for places for certain industries to fight it. And I think that's one of them that, I think is more well positioned than others because it has a union. Like, there's not like a menial workers union, like where people like that are just kind of like pencil pushing in offices. Like, I think those are kind of like the hardest jobs. And I'm trying to think of like, maybe like a business analyst or like, certain accounting functions and things like that, those aren't necessarily unionized. And I think those are just going to have a very hard time not getting eliminated. But something like this that does have a union, very star driven, we really do have to see if those stars are going to alert their pressure to make sure their whole industry is taken care of, or if it's just going to kind of, if they're going to see the writing on the wall and say, hey, I got to keep making my money and take care of myself, which we didn't necessarily see, by the way, in these strikes. But there might be in between where they say, okay, like some of these functions are going to get eliminated, but some of them are not. And we're going to hold strong on those. It's going to be interesting. That and many other industries.
Yeah, so wrapping up this topic, just one last thought based on everything you were saying. I forget where I saw it, but I read somewhere that someone is predicting that there will be a person that is able to create $1 billion company alone, like a solo person, which had never even been possible before. But with all these AI tools and kind of like the menial jobs that you were talking about, how much of those tasks are going to be able to be done by AI? They were predicting that a single person could start $1 billion company. Do you see that happening one day?
Definitely. I definitely think it's only a matter of time before that happens. And that's going to bring up very interesting like topics on like, wealth concentration and what we do there. Because like the more and more that happens, the more kind of like intrinsically there's less jobs in our economy. And then what do you do with that like mass unemployment? Like there's some things like we see some people, and it's been true in like a lot of industrial revolutions, like, or like, I'm thinking the main one, everybody was like, oh, these factories are going to come around and there's not going to be jobs. And there's people that say like, there's jobs that are always created. But and that could be true, but there are, there's something very different about this than other things, where it's just like before in factories they were automating things that were very obvious for machines to do versus people. Like we're now moving on to like, and people always said like, things like artistic jobs, those would be the ones that like machines could never do. But like we have machines like, making, doing writing jobs and making music. And there's like a lot of things that was supposed to be something that, machines could never do, and we see them doing. So I see there's things that make up a very different, that have a very different makeup for this.
Yeah, so we have a big 180 spin. We're going from, the futuristic tech talk to staple strongholds, simple companies that kind of been crushed this year so far. We're going to talk about Nike and Starbucks, two, strong American brands. Almost every household knows them. They've both not been able to catch the market's uptrend. If they're not at 52-week lows, they're close. I think it's kind of funny. I know it doesn't really matter, but they're like almost identical in price. They're both around $75 right now. I was gonna try and bring them both up and do a would you rather for which one would you rather purchase now, if either. I know you wanted me to get the market caps for you. So Nike's market cap is 111 billion right now, and Starbucks is 85 billion.
All right, let's check it out. All right, I know Nike has been looking. I've actually seen Nike in like some of the bottom of our screeners. But it looks like it's turning around. Might be if you have short-term plays, that option sentiment has really turned around on Nike. Let's check out Starbucks. Starbucks is looking, less strong in the short-term signals, but its upside is higher than its downside, which is a big thing, and that is not true for Nike. Nike was like way higher. So yeah, I'm taking Starbucks. I don't like either of them right now, like just for a very clear reason of we're not seeing a good environment for retail. And I think especially like things like Starbucks, like that has like oversaturation. I think that's a big thing that they're gonna, I think, have to close locations, and they've been like big location openers, and like how is that going to do with their strategy? Like we don't know. So I think there's definitely that. And then like on the Nike side, I think one of the things that we're seeing a lot more of like in apparel are like smaller apparel places that similar to Starbucks, where it's just like, oh, like I don't want to be like giving my money to this kind of like huge company that might not treat their workers very well, that has oversaturated the market. And then Nike, I think we're seeing a move towards like smaller apparel companies that are more ethically sourced, that don't make sweatshop things. That I think we're seeing like that's something that we talk about at Prospero all the time, that I think the biggest trend we're going to see in this century is more and more people caring about like the ethics of businesses, and those are not really known as the most ethical businesses. Granted, we've talking about some other businesses like Coca-Cola and McDonald's that have started to do better, but I think those products are like much more like etched into like American society and those are also lower cost products. I think when you start to get into like Nike shoes are not cheap, and when you start to get into like higher price points than that, like I think you start to see people being like, oh, maybe I'll pay a little more for an ethically sourced item. And I think the big thing with Starbucks is it just got like a lot of tough headlines in terms of what I would say is unionization. That's not necessarily like a cheap product. It's not necessarily as like expensive as like another cup of coffee, but I also think that we're seeing more and more people care about like kind of like artisan coffee, and more and more move towards that, where it's just like, okay, Starbucks isn't cheap. Like I think McDonald's is definitely cheaper than Starbucks, and we see McDonald's seeing like like a $5 meal now, and then we also see like um Coca-Cola is still like a relatively, cheap mass-produced product, relative to other drinks, I would say, especially coffee. So it does have that going, and they have some exposure to energy drinks, which are becoming more and more popular, and is kind of another substitute for coffee. So I think you kind of see, two businesses. I think you see like kind of classic American businesses, one that is like staying more at the price point that America is comfortable with, which I think people are more more comfortable making ethical compromises on that. But also, you don't see the big ethics headlines that are as problematic with Coca-Cola and McDonald's as we have seen with, Starbucks, and especially Nike at higher price points, where you're just like, if I am going to be spending like $60, $100 on a shoe, maybe I do care about ethics at that price point, and I am going to get a little choosier.
It would be interesting to me to see if there's any correlation with the age of a company and like how quote unquote ethical they are in their production, because the ones that were started a long time ago, people probably didn't care about as much, and maybe there's some kind of connection there. We have a question from Saucepot related to this topic of, do you think a trend towards ethics in business will affect tech companies that rely on unethically mined metals?
I think there has to be an obvious alternative. And I think we're seeing that a lot with shoes. Like there's a lot of businesses, like shoe businesses, that are starting up, and like part of their ethos is like, hey, we're doing this ethically. I don't know that many like ethical chip companies like that are legit alternatives. And I think you're talking about also a big difference, B2B, B2C. I don't think many B2B businesses care about ethics until maybe they're called out about it, and then they might react a little differently. But, there's not necessarily a lot of like B2C, chip companies. And if there are, I do think if you had a company that really did a lot of marketing and saying like, hey, like we, especially as like a PC maker, say like, hey, we use ethical chips, and people have that alternative at those kind of higher computer price points, you might see that happening. But I haven't necessarily seen much of that, so to speak. So you do have to have those clear alternatives where people can choose.
It's almost like Saucepot knew which company we were going to talk about next, because we have Apple. Speaking of unethically mined or produced materials, but there was an update in the Apple versus Epic Games, which has been an ongoing battle for Apple for years now. Actually, that they approved Epic Games gaming marketplace app on iOS, but only in Europe as of now. So this is the real first crack in the stronghold that they have on the App Store. It would seem. Maybe you can predict or talk about if you think it's going to expand beyond Europe. This problem, if maybe this win from Epic Games will lead more companies, in spaces outside of gaming, to create their own marketplace apps in the App Store. Is this a big problem for Apple and their App Store stronghold?
Yes. I mean, I think you always I think you always look at these court cases, and I think why everybody like fights them so hard is like it can open the floodgates. Like once people see like your vulnerability points in court, you definitely see other people like kind of tacking on to that as well. So I absolutely think that we are going to see more and more of this occurring, and it's definitely a threat to Apple's business. We've seen a bit of a resurgence because I do think, relative to their value, they're incorporating AI products, which they had to do, even though it's a Microsoft product. But yeah, I think that, Apple is just something that, again, we would have in like our higher risk portfolio because of the way their sales are not producing, as well as the other Mag 7. They become like a less exciting thing for us, but something that we're willing to own in kind of like our higher risk, higher volatility portfolio. But yeah, I think there's a lot of risk factors with Apple. I do like what they did in moving their like starting to move their manufacturing more to India to like reduce their China risk, because I do think that was a major risk for them. But they need to start coming up with new innovative products. That was always Apple, and we always said this, they kind of fell flat on their face with the VR headset, and they're not doing that anymore. And until they, until they do better with that, until they start to innovate again, like I find them to be the second most risky business in the Mag 7 versus Tesla. And I'd still probably rather own Tesla because Tesla has way more upside to go along with that risk.
And even so, Apple stock is kind of, like you said, they've had a resurgence recently. Can you explain that? I know they released some AI updates, but they've had a pretty nice recovery from where they were kind of moving nowhere for a while. Anything else to point to with their stock kind of breaking through 200? I think they're up to like 225 now.
Yeah, I think people are seeing them start to become a value, especially as they rolled out more AI. I think they were looking like a kind of dinosaur company that was just kind of like dying. And I think them making that move to, ensure that they had that usability with AI that would like keep their phone sales really good and kind of continue to be like a hardware leader in what I think they are, like ease of use. I think that was a big step for them, and people were looking them way too risky in terms of not being a company that had a product that had good ease of use. So I think that kind of that shifted when we saw that happening.
So we're about to get into the last topic of the day that I have, but before we do, we have a tremendous amount of viewers, which is great. Love to see you all in here. Thanks for tuning into the stream. If you enjoyed the content we've covered so far, like it up, and also get your questions in the comments now while you can, and we'll be happy to cover them before we go. But this is a funny story that I think it's kind of something that you point out, George, all the time when I bring up, deals that happen in the stock market between two companies. You kind of talk about how you never know what's on the back end of the deal. And there was a story that came out that Microsoft just told all of their employees based in China to switch from Android to iPhones. And I think it's kind of funny right after, the Apple and ChatGPT announcements come out that this takes place. And it wasn't in the headline of the deal, but it's connected. It's got to be, right?
Yeah. Well, I think that could be a big alliance in terms of like both of their wars with Google. And we talked about like, Apple looked at using Gemini, and then they ended up going with Microsoft because like obviously in terms of computers, that's like a much bigger battle. But like the thing that I'd be interested to see is like just much friendlier, like if there were starting to be like office programs made for Mac. Like this was like a larger alliance where they're just like, okay, we want to compete with Google Docs. Like we might integrate some of the office programs. You integrate like our AI and like, do like add-on prices. Like that's the thing that I'm interested in seeing. And I think the phone switch is absolutely a step in that direction, where it's just like Microsoft and Apple have decided, like in the great AI wars, that they'll throw aside their traditional hardware, battles to fight Google. Because we always talk about Google having like the bigger AI brain. So this might be like an all-out war to just kind of beat Google on a larger time scale. And we've talked about this. For those that don't know, like apparently Elon Musk was really like trying to get OpenAI to take on more investment from Tesla, because he said this is the only way we beat Google. And he's very cognizant of like Google's AI lead in terms of like the brain that they have that we always talk about. So this could just be like some strong alliances in trying to fight Google, like having long-term AI dominance. And it may be interesting if Google makes some non-traditional alliances of their own as these like battles, like, coalesce. Like, yeah, I mean, it would be interesting to see. I mean, certainly if Microsoft started to make their own chips more seriously, and maybe Microsoft and Apple had like a thing like that, maybe you might see like an NVIDIA Google alliance. We actually saw like, I think, talk of like an SMCI Tesla alliance. I think we've seen like some of that. So yeah, the great AI wars appear to be like kicked off. And like this is this is a big like potential, like I'd say this is a big alliance that we're starting to see some powerhouses kind of firing the first shots at Google in these AI wars.
That's funny. It's like this is Survivor, alliances amongst the Wall Street giants. That's kind of
I was
funny.
thinking about Game of Thrones. I'm just rewatching it because my girlfriend hasn't seen it, and we're just like tearing through it. So yeah, I was thinking about this as like some of the great houses aligning
Hmm.
in the AI wars.
Oh man, lucky Game of Thrones. I watched it through once. I haven't seen it in a while, but there's a new one that everybody's telling me to watch. The prequel. That's what is it? Something Dragon, House of the Dragon.
Yes, I
I've heard
watched
it's
the
very
first
good.
season of that. I didn't love it. I heard the second one is better. But yeah, actually, we're one of the reasons we were watching this is I felt bad trying to get her to watch that one before watching the original one. So we're getting through this so we can then watch House of the Dragon.
Hmm. And maybe you're in a a nature wilderness mood because I see a comment on our Twitter right now. Is George wearing camo? Let's go. Maybe it's some of that
Yeah,
Game of
I
Thrones
actually
effect.
have no, these are some matching shorts, and I actually have a suit jacket. It's a funny story. I got all of this in in London because I went and I didn't have a coat. And like it was so cold. It was like it was June, and I was like so surprised that I actually needed a coat. So I was wearing like this one. I was wearing just like a suit that I had there for warmth, and then like I got tired of wearing the same. So I got this with like the matching jacket. Maybe another live stream. I'll wear the whole ensemble, but it's way too hot in New York right now for that.
Oh my God, yeah, it's on fire. That's a funny story though. I don't see any more questions from our chatters.
I'd love to do. I think I want to do the trading letter update just to get it all out of the way today.
Okay, so we'll do a switch
Uh,
over.
we're gonna do the switch over.
Sounds good. We'll see you in the Prospero.Ai laboratory, George. Um, so I'm not sure for everyone who's watching right now if we're going to do the model portfolio. I don't think so. But if we do, that'll be cool to see. George update the positions. But I think we are going to write the trading letter at the minimum. So you'll see how George is feeling about the market currently. And let me update you all on what we are seeing in the markets. So the QQQ is up 0.25%. The SPY is just above the flat line, and the Dow Jones is negative 0.14%. So they're all trading in their own directions today. Let's update everybody on the net options sentiment that we are seeing in the markets. So the QQQ remains in a bullish level. It's at 56 right now. Let's see where it opened today. It opened today at 57, so remaining high, slightly lower. Not much to pick up on there. Net option sentiment for the SPY is at 48. It opened the day at 50, so it dropped 2 points from the beginning. And you know what? Let's look at the Dow Jones because maybe we should start looking at that as well. What is the Dow Jones ticker? DG.
Model portfolio update is faster now. Can you hear me?
Yes, we got you, George.
I forgot it's faster now ever since we made this adjustment. All right, we're going to see how quick we can do this.
For everyone, I didn't mention the IWM is actually up 0.6% today. So the small caps are the best performing today.
Oh, interesting. We will take a look at that in a second. Can you give me an update on QQQ, SPY, and an option sentiment?
Mm-hmm. So the QQQ is at 56 and the SPY is at 48. the energy continues to lag, we will definitely have to target at least one name there. Possibly pull back on our communications positions as well. Small cap is showing some strength, but one day is not enough for us. If we see another strong day tomorrow, that's when we'll adjust our positions.
I thought we'd be doing better. Sometimes it requires a refresh. No. Oh well. We have 3 micron. Is EME a win?
Sorry, I think I'm gonna have to reload this page. It's not working right now. Oh wait, I got it. EME is a loss.
All right, we'll hold a little longer. How is PBR doing well when all these other energy stocks are sucking? All right, we're not gonna. Ferrari. Okay. Let's get some Ferrari. Do we have a Palantir open? I want it to.
Yes, we do. Just one.
All right. I think I'm good on this. How about GEs? I think we had.
Yep, we got one GE.
I think I like. I think I like GE for the trading portfolio for the. I'm going to check the signals, but yeah, I'm grabbing it. Actually, I'm going to wait. Some other good ones here. All right, I think that's good. Did I get that right? Tensu Group. Normally, we don't pull up things on other stock exchanges. Oh well, we're not going to look at that. Okay, this I might need to do right away. Yeah. Gotta get on this. All right. Had to take care of that immediately.
So we have a question in the chat. When you make adjustments to the model portfolio in regard to long-term stocks and it says drop stock X, does that mean exit it entirely?
What?
When you make adjustments to the model portfolio in regard to long-term stocks and it says drop stock X, like random stock, does that mean exit it entirely?
Does that mean exit it entirely? Well, sometimes it says like one of two or more than that, right? You know?
Yeah, so I think
Like,
it's that position, like you're dropping, right? Like if you have multiple positions open, you'll let them know how many you're dropping or how many
yeah,
are open.
when you see this, like 2x, one of two, this says the number. Like, oh, I think this was actually one of three. That's a good point. And then I'm going to put okay. All right, what are we doing here? We are we need the model portfolio. All right. So, I wanted to look more at this. MGY. We can grab one of those, but we don't want to overexpose. To energy. So maybe we're going to just do one more. Okay. All right. All right, WTI, because we looked at this. Let's look on the daily now. Okay, I think we're done with energy. We're just going to look at some other things now. ASC, I know, was down a bunch today. But maybe. What's going on with ASC net option sentiment?
What's the ticker? ASC? ASC?
Mm-hmm.
Net option sentiment is currently at 17. It was at 50 to start the day, but it's pretty volatile, going up and down throughout those ranges throughout it. Adam's asking, how long do you typically hold the short stocks?
Well, you can see like the average hold in the in here. So it's like 23 days. Back to this. How about Jack? No. Do we have Save open? I think we got a Spirit Airlines at one point. I think it's a lot of airlines though.
Not seeing Save.
Oh, I might have just debated doing it and didn't do it.
One is closed, so maybe that was that. That was back in November, though.
No. This seems like one of those small cap ones. INMB. It's too far down already. Might have missed the vote. This is one we've written a few times. Oh, yeah. We might get into that one, too. All right. I'm feeling good about this. All right. That's good. We want to get it out at 12:20 to make it easier. All right. Any other questions?
Nope. Just Adam saying thank you for answering his that I see right now.
All right. Then I think we're good.
All right. Thanks for everybody coming back into our stream. We'll be back again Wednesday, 3 p.m. See everybody there. Bye.